All right, we are going to go ahead and get started. So thank you everyone for joining us today, and welcome to today's webinar, Homeownership in Your Future, hosted by the Rural and Native American Initiative here at Enterprise. My name is Sarah Torcell, and I'm a program director working under the initiative. I'm going to go over just a few quick logistics, and then we'll begin the presentation. Some of you might be streaming audio, and it usually works fine, but sometimes local conditions can cause issues. If that happens to you, you can switch to a phone line for audio. To get the dial-in numbers, click on that little circle to the left of the red button on the bottom of your screen, and once that menu opens, click Audio Connection, then switch audio. Follow the prompts, and you should be able to call in. I also wanted to make a note that this event is being recorded. We'll be sending a link to the archive to all of today's participants within the next couple of weeks. There will be time at the end of the presentation for questions. All participants have been muted upon entry, but to ask questions at any time throughout the presentation, you can write in your question using the Q&A panel and direct your questions to all panelists. Here's a graphic of what that looks like. You can also send your questions directly into the chat box. And it looks like we're going to have a pretty small group, so I may also unmute the phone lines at the end for questions. So with that, I'm going to turn it over to our presenter today, Russ Caney.
Thank you, Sarah, and welcome everyone to a overview of home ownership. And we wanted to do this month in June because June is National Home Ownership Month, and there's a lot of organizations that are in the housing industry that have highlighted some of their work, and it's certainly important to recognize the important work that's going on around the country. Just before I start with that topic, just a brief introduction about Enterprise and Enterprise Community Partners. We're an organization that's 37 years old. We were started by a developer, James and Patty Rouse, in 1982. And there's a lot of moving parts to Enterprise. We are involved with the technical assistance and trainings, particularly with our group. We're involved with Enterprise Community Investments, which buys low-income housing tax credits and makes equity investments in rental housing. We have an Enterprise Community Loan Fund, the CDFI, that works nationally. We're involved with New Markets Tax Credit Program, involved with Opportunity Zone funds and have a couple of funds out there now. We have a Rose Architectural Fellowship that some of you may be aware of, where we place young architects with host organizations for community development and affordable housing. All of our work that we do is based on affordable housing and community development, so that is the main theme of everything that we do. We have offices in 11 major markets. Our home office is in Columbia, Maryland. We have a policy office, very active policy office in Washington, D.C., and we have folks in some of the major market offices that are also working on and monitoring local and state policy, which has become very important and a real driver in many areas of the country for some of the good ideas in affordable housing. It's just not from the top down, but really grassroots energy and policies and programs that are being put in place. Within Enterprise, we also have the National Initiative staff, and the National Initiative staff, really about 40, 45 people that work on programs that can go anywhere across the country. Health and housing, green communities are a couple of those programs. But within that program is the Rural and Native American Initiative. And that's who I work for, Sarah works for. Adrienne Norwood, who is in our Washington, D.C. office, is a recent addition to our staff. So welcome, Adrienne, and she'll be participating and helping with some of the webinars and training sessions going forward. So with that, let's jump to the next slide and just talk a little bit about the history of this idea of National Home Ownership Month. You know, back in the 20s, it was actually recognized in a week-long celebration. And it wasn't until 1956 that it was kind of taken over by a bigger organization, the National Association of Realtors, which, of course, is a very large organization, but again, only dealing with a weekly type of event and recognition for home ownership. In 1976, it was renamed Private Property Week, so there's lots of different kinds of private property. In 1986, it was renamed again American Home Week. And then in the 1990s, it got a bigger push, particularly during the Clinton years, 1992 to 2000, when home ownership was highlighted, and a big push was on to make more individuals and households homeowners. And then finally in 2002, President Bush proclaimed June as National Home Ownership Month, and it's been recognized that way ever since. So today, we're going to spend some time talking about advantages, disadvantages of home ownership. We want to look at some of the big picture issues of home ownership, and then we're going to take a brief look at some individual homeowner factors, kind of am I ready for home ownership, and then briefly look at several programs that are out there that deal and lend for home ownership, and particularly in our area of rural and Native American housing. So first of all, why home ownership? Well, we can list a number of benefits, but these are some of the bigger ones that I typically try to highlight when I'm talking to families and households about home ownership and thinking about it. And obviously at the top of the list is security and stability. And really being connected to a neighborhood, having access to health care, having access to transit and jobs, having access to schools that you want to go to, and having an opportunity to start building equity, building wealth. Typically, a house is going to be the biggest asset that any individual or family is going to own. And so it's a big decision. There's a lot of effort that goes into it, and just a lot of coordination and really scouting out where you want to live. But there's a lot of factors that come with owning a home. Obviously, with home ownership, there's a whole industry that's built around home ownership in this country. It's an economic driver. You're always hearing about home ownership reports and how many houses have started to be built in a particular month. So it's a key factor in the economy of this country, not only supporting builders and the labor that goes into building homes, but also the selling of homes, buying and selling of homes through the whole realty industry. And then obviously the manufacturing of homes, the products that go into it, wood, and all the pieces that go into a home, and then the retailers that are looking at materials and products and landscaping materials that people are looking at for their individual homes once they are living in a particular neighborhood. So with the next slide, there are some disadvantages just to think about home ownership, and it may not be for everybody. It is an illiquid asset. And by that, I mean that once you buy a home, it is an asset that can take a while for you to sell or convert into cash if you're looking to move to another area of your state, another area of your neighborhood, or even another area across the country. So it can take a while rather than renting, where you can give a 30-day notice typically with a lease and you're out and can move. It takes a while to unwind from a house. Another disadvantage that some people like to point out are the property taxes. When you're a renter, you do not have property taxes. The complex and the owner of an apartment complex where you may live, or a single-family home or a duplex, they're paying property taxes. You are not. It may be in part of your rent, and that's how your rents can go up if property taxes go up. But if you're a homeowner, you have property taxes. They can increase, not always, but we'll talk a bit about that, what makes up property taxes in a bit. And then, of course, home maintenance is all in your lap. You are responsible for home maintenance. Again, comparing to being a renter, you call the landlord, you call the maintenance crew, they come and fix it, they mow the grass. When you own a home, all of those responsibilities are going to be yours. And then I've just listed a couple of things here that have popped up in, of course, the last 10 years. We've all gone through the the recession and the housing bubble from 10 years ago. And since then, we've had just a number of different things that have happened from the standpoint of lots of single-family homes being rented, investors entering the market and buying up a lot of single-family homes for rentals and taking them off the market, people starting to get back into flipping homes again, basically trying to buy them, fix them up, and sell them at a higher cost, and then what I call the piggy bank syndrome, which before the recession became a major issue. People taking money or equity out of their home and spending it for other things, some very worthwhile, some not. And as you're starting to see housing prices go back up, you may see this arise again as an issue for some households. So with the next slide, just wanted to go through basically some interest rates that I found out there, and these are as of about June 12th, and I took them off of a national newspaper. And we are in a very unusual period and have been since the recession, since 10 years ago, where interest rates have been in the single digits and have been at historic lows. And when I think back of getting a mortgage many, many years ago, and I had to take out a mortgage, and it was the lowest rate that I could find at 13.5%, it just seems very unusual, and it's like eons ago that we would have those types of double-digit interest rates. But a 30-year fixed rate at under 5% is considered exceptionally low. Earlier this month, we were actually, and these are nationwide averages, of being almost to 4%. And of course, on a conventional mortgage, as your interest rate goes lower, your payments go lower, and if it's a fixed rate, then you're locked in with a payment that is not going to change. You can find even lower rates than that if you're looking at a 15-year fixed. These are shorter mortgages, higher payments, but you're paying off the debt or the mortgage much faster. You also have, and what became very popular in the last 20, 25 years or so, particularly products that have been out there that were aimed at individuals and households that could not perhaps meet 30-year fixed rates. A 5-1 ARM, where you have an adjustable rate mortgage. You're locking in an interest rate. You see some rates there for 5- and 7-year ARMs. You're locking in an interest rate for 5 years or 7 years, and then at the end of that period, you are adjusting the interest rate to whatever the rate happens to be at that point in time. So you might be in a situation where you only anticipate living in this home for 5 years or 7 years. That's your horizon because of employment or some anticipated move, or maybe you just want the lower interest rate and gamble that you'll be able to refinance at the end of 5 or 7 years into a better rate, or at least a rate that you can handle at that point in time. And then I've listed here also just a 30-year FHA rate, which the Federal Housing Administration typically has rates with lower down payments that are very attractive to many people. So on the next slide, just want to talk a little bit about housing values. And of course, in 2006 to about 2009-10, we went through the housing bubble and the severe recession, and a lot of it brought on by housing and housing foreclosures and housing that became very much a burden for many households and many families across the country. And as I look back, I see, in talking to a lot of younger people and maybe households that are starting to look at buying a house and some of the values there with housing and some of the advantages of housing and being a homeowner, they know people, whether it be neighbors or family members or maybe even their own household, that went through a period where it became very difficult to make your payments. Not only was there a housing bubble and a loss of value in homes, home values actually went down. They don't always go up, but people had problems with unemployment and income. And so you were in situations where if you knew family members or you were in a household where you went through a foreclosure situation or had to talk to a bank about trying to have a moratorium on payments, trying to figure out how to do a short sale being where you're actually selling the home for less than the debt on the home and then negotiating the balance of the debt with your lender. These were all very difficult times, and so it hurt not only financially, but I think from the country's standpoint and from the housing market, it hurt psychologically also. If you were in a situation and realized that that had happened or happened to people that you know. So coming out of the recession, inventory generally, and this is maintained today in 2019, inventory is rather low and tight, and construction is considered low based on historic levels. This can be due to a number of factors. It certainly isn't the interest rate because those are low, but it has been the economy, and the economy has low unemployment right now. But obviously you need income and a certain amount of income to be able to afford mortgage payments. So with kind of the stagnating wage industry, high material costs, a tight labor market, this all has driven up the cost of new construction. And as you go to some areas of the country, many areas of the country, you're finding where appraisals are not justifying new construction for home ownership. And this would be a situation where you will have existing homes that are selling and would sell at a value that you could not build the same home for that same price. It would cost more if you tried to build. So you're not going to get an appraisal that's going to justify unless you can come up with a lot of money down to be able to make that work. And then a lot of homes have just been taken off the market by investors. You've had some Wall Street money, and you've had significant amount of investment come into buying up single-family homes in certain parts of the country and turning them into rentals. And the reason for that is that the rents have continued to outpace inflation, have been good investments. They're buying many of these homes in the bottom of the market. Some of these homes that needed some repairs and rehab, they've done that, put them out there as rentals. Eventually, as an investor, they'll look to sell these, but you don't know when. And in the meantime, they have been taken off the market, and which has just tightened the market from the standpoint of overall homes out there. And then you've seen the trend of other homes, single-family homes in particular, in certain markets being turned into short-term rentals, such as Airbnbs. And this has been, again, just a phenomenon that we've seen in the last probably 5 to 8 years. So the next slide, just talking a little bit about home ownership and some of the percentages. The majority of occupied households in this country are owner-occupied, which is a good thing. There's been a lot of efforts put into making people homeowners, and we talked about the benefits of that. That home ownership rate actually peaked in 2004, just before the recession. And then it continued to fall until 2016, and now we're starting to see it uptick again. And just some of the trends that are out there we're seeing is that people that are considered baby boomers, let's say 65 and older, you're starting to see a decline in their home ownership rates, but that would probably be natural if you think about as people age, and some people want to live in their homes and age in place, but others may be trying to downsize. They may be in a situation where they sell their home and they become renters, and they don't want the maintenance, they don't want the property taxes, they don't want the mortgage payment if they had one at all, or they may want to look at an alternative type of housing. So those homes typically will come on the market, but that is a trend that you're seeing with older Americans. On the other hand, you're seeing millennials, and millennials will define as individuals that were born between 1985 and 2004. Those folks, and it's a very large group of Generation Y individuals, they are starting to buy homes, and at the younger age, they're going to be coming into their prime home buying periods here in the next 10 to 15 years. that is a very large segment of the population. The millennials actually are a bigger group collectively than the baby boomer market. And adding in immigrants and others, that could very well be 100 million people involved in the millennial segment of the market. So the top end, about 34 years old, they're starting to form households. They're starting to think about buying a home rather than renting. They may be in a more stable situation from the standpoint of employment. They moved out of the basement of their parents' homes, perhaps. Just a lot of different situations. And they're really going to be prime for advancing the home ownership market going forward. The next slide, just a few factors to be considered, and really it gets down to some of the questions you have to ask if you're an individual or looking to buy a home, or if you're doing some credit counseling with a family or an individual. Am I ready? And do I need a down payment? These are typically can be barriers and some things that people in the back of their minds think, well, I can't buy a home, I don't have any money to put down. And if that is the case, you do need a down payment. How much? And what are the sources of that down payment? Do I have to save all that money, or what do I do from the standpoint of trying to gather up those down payment costs? If you get into a program that does not have a down payment requirement, and we'll talk about a few of those in a minute, you still have some closing costs that you're going to have to deal with. And those closing costs, in some cases, can be substantial because you've got appraisals and you've got inspections on a home to make sure that it's livable, things work, furnace works, the roof is in good shape, title insurance, different things that you're going to have to pay for and deal with. So that, again, is costs to be aware of and to look for sources to help with those costs. And then the credit and debt history. It's very important, and so important from today's standpoint that people are looking at credit reports in some of the home loan programs. They're looking at FICO scores, looking at your total debt, and that's always been an issue in the process of owning a home. So the next slide, just on the down payment aspect, the traditional programs, conventional loans, if you will, typically will have an 80% loan, 20% down payment. And I bring this up, and there's a lot of these loans being made, but for a lot of individuals and families that we work with at Enterprise, they're not putting 20% down because they don't have 20% to put down. And I know that home values and pricing is all over the board as you go across the country. So I just put in here a conventional loan as an example, $150,000 home. And this would be more of a kind of a Midwest home. Northern Illinois is where I live and I'm speaking from. And you have some loan limits for some of these programs where you have some income restrictions that the loan limits may be up to $165,000, $170,000 for a home. It could be $370,000 in California, same program, so it really does depend on where you are in the country. But for an example, only $150,000 purchase, and you had a 20% down payment, that would be a $30,000 down payment, $120,000 loan borrowed at probably what you're going to find is the best terms that are out there. If you're putting that much down and you're taking some of the risk of the home going up in value, sideways, what have you, you're basically going to get the best rate from a community bank or from many of these programs. And you're not going to have any mortgage insurance. Typically, mortgage insurance is going to be required on any loans that are less than 20% down, and mortgage insurance basically gives some comfort to the lender that the mortgage will be paid off if there's interruptions in income and other situations that might arrive. You do have other programs that are out there, however. FHA has a very low down payment threshold. Veterans Administration guaranteed loans have 0% down. The 502 guaranteed loan with USDA has 0% down payment, as does the 502 direct loan with USDA. And it has some low down payment requirements on HUD 184 guarantee. This is a program that guarantees loans to lenders for Native Americans, tribal members, and has low down payment requirements, and even lower if you're borrowing less than $50,000. It's about 1.25% down payment. So the next slide, just wanted to talk a little bit about credit and dig into that a little bit more. There's lots of things that you can do as an individual household to start getting ready for the home ownership experience, and just some questions you can start asking. And there are a number of online educational pieces that can help you ask the right questions, and really to be honest with yourself. Do I have the income, and is it enough to be able to borrow for a particular program to buy a house? And do I have employment and steady employment? And what does my credit look like? It's very important, I think, to know what your credit report says. And a number of years ago, there was an opportunity and a law passed that allows each individual to go in and get a free credit report from each of the three major credit reporting services that are out there. These are Experian, TransUnion, and Equifax. And they are free. You can get one per year. And what a lot of people I know do is that they will go in and they'll order all three, not all at the same time. They will maybe order one credit report from one of these companies in the first quarter of the year. Then maybe over the summer they'll look at another. And then maybe in the fall they'll look at the third one. And what you're really looking for here is some consistency that backs up what you've actually been doing with your credit. And credit reports will have everything in there, from credit cards to borrowing for vehicles to any type of defaults or payments that you haven't made. It will rate them, and typically you're looking at these credit reports for factual information about you, and no one should know your credit better than you, but also looking for errors, because you don't want to wait to approach a lender or have someone else, a third party, that you give permission to look at your credit report and then start asking questions about errors that they found on there that you know are errors, but you just haven't had the time to clean up, or were even unaware of those. Those types of errors, to clean them up with a credit reporting agency, can take time. Sometimes it's you that has to go back to the issue, the credit card company, the hospital, whoever initiated the bill and ended up putting it on your credit report to help get that corrected. And many times it's easy to do. It just takes time, and something you'd want to look into as soon as you can. So it's important to review those. And let's face it, everybody doesn't have good credit when you take a look at some of these credit reports. So you want to take a look and see where the issues are, be aware of what lenders are going to look for, and then just start taking the time to resolve some of the issues that you may have on the credit report. It really comes down to your ability to pay. That's going to be the bottom line for most lenders. Everybody doesn't have credit, so everybody's not going to have a credit report that's going to be lengthy. And there are a number of initiatives out there that are helping individuals and households build credit. There's a number of credit unions and banks around the country that are making very small loans, $500 and $1,000 loans, and asking that they be paid back over a 12-month period, an 18-month period. And it's nothing more than to establish your credit, to get something on your credit report showing that you borrowed money, that you've paid it back, and you started a credit report. You're seeing other organizations that have started programs of reporting your rent payments to the credit bureaus. If you're making your rent payment on time, typically that's not going to show up on a credit report. But if you're doing that and you're being conscientious about making those payments, it can be an important source to be added to your credit report and allow you to get credit for that. Don't be fooled by these some of the ads you see out there on the internet for these credit reports. There are some that are out there that are actually charging for these credit reports, but you don't need to pay for a credit report. They are free. Again, one per year from each of the three major credit reporting services. So the next slide, just want to briefly talk about FICO scores. You know, FICO scores came out in the early 1990s. They were somewhat controversial. Some people complained about them because it was putting a score on you, kind of making a judgment on how you're making your payments and your credit worthiness. But they've lasted. The FICO stands for Fair Isaac Corporation, and it's a range of 300 to 900. And if you go out there, you're going to see, and particularly when you look at a service like Credit Karma, which is a free service, you can enroll to Credit Karma, and they will update you anytime you want. In some cases, they'll send you a monthly notice if you want to check your FICO score, and you can access Credit Karma, and they'll give you your number, and they'll tell you whether it's going up or down. It's a free service because they're selling things. They're selling advertising on their site. And if you fish around a little bit, you'll see every major credit card company in the world being on the Credit Karma site trying to sell you a credit card, trying to get you to use their card. So that's how they pay for their service. Before Credit Karma and services such as that, you could get your FICO score from a bank. Sometimes they acted like it was a big secret, but it really shouldn't be. And FICO scores probably have lasted and have become kind of an industry mainstay because what it's done is it allows a bank or a lender to quickly figure out whether you're creditworthy. If you have a FICO score that's in the 500s or below, they're probably not going to make you a loan, and they're probably going to ask you to get some credit counseling and maybe help you figure out why your score is so low. And what makes up a FICO score is payment history, the amount that you are owed, not owned, but the amount owed, the length of credit history that you have within your mix, what the credit mix is, credit cards, vehicle loans, other types of loans, and then any new credit. So obviously the big two are going to be the amount that you owe, but the number one percentage that goes into your FICO score is going to be your payment history. So the next slide, just some things to think about in your ability to borrow. If you don't do household budgeting and don't know where your money goes, it's important to know that. So if you're getting serious about buying a home, you really do need to know where your dollars are going, your take-home pay, your take-home dollars are going. Your income is going to be important for the lender. And is it trending up? Is it going down? Have there been disruptions in your employment? If there have been disruptions, know the reasons for that and be able to explain those. Your household expenses, everybody has to pay for food, clothing, utilities, your day-to-day, but it's the other, after your household expenses, that's going to be important from the standpoint of what you have available for a housing mortgage. You're always going to have other debt. Most people cannot avoid a vehicle loan. Credit cards can be avoided, but sometimes need to be eliminated to make a housing mortgage work for you. Medical bills may be there in your future. They can be a debt, but again, it's something that can be managed, and to be aware of what those are and how that's going to be explained to a lender. And of course, the big one that's come up, particularly for a lot of the younger households and younger people that I talk to, are student loans. Student loans have become a big issue, lots of debt out there. It took 4, 5, 6 years to accumulate these student loans. They're certainly not going to be paid off in a year. Many of them are large numbers and just have to have a plan to work on those. So am I ready? You may not be ready with debt in some cases, but you can certainly start a plan to work towards being ready for home ownership. So am I ready with rent? Rent typically is monthly and typically goes up. So that is compared to mortgage payments, which are typically monthly, but they're typically fixed. So it's a big difference from the standpoint of what you're looking forward there. Again, rent, you can get out of an apartment usually with a 30-day notice. With a household mortgage, you've got the mortgage for a lengthy period of time. Just going back to the rents, and at least 11 million households in this country, 1 in 4 renters are paying more than 50% of their income towards rent. Rents have gone up quickly in the last few years, faster than the rate of inflation. And people really get stuck from the standpoint of paying out a lot of money for their rent. So if you haven't looked at mortgage payments on a house that you might be thinking of, you may be surprised that your mortgage payment would actually be less than a rent in some markets. So real estate taxes are inevitable with home ownership. They could go up, they could go down. It just depends. It depends on what your taxes are for, where you live, and I'll talk about that in a minute. Insurance, you're always going to have insurance on a home. It's going to be required by your lender. You're going to have fire insurance, wind insurance, flood in some cases. Increases in insurance are probably likely in the future with deductibles and such. You can keep that under control. But with some of the disasters and some of the unusual events that we've seen, tornadoes, flooding, and such, I think you can count on insurance probably being elevated in the future. And then, of course, maintenance, the repairs on a home, replacement of certain pieces of the home is always constant. You've got to mow the lawn. You've got to take care of the home in the future. Just going back to the tax bill, if you've been a renter all your life and have not had to pay taxes, it's interesting because just taking a look at a typical tax bill, and I looked at mine the other day, I do own a home. I'm fortunate enough to own a home. About 68% of my property tax bill goes to the school district for our K through 12 schools. About 10% of my tax bill goes to the county. About 6.5% goes to the local fire district. Very important to have one and close by and know those folks. So I'm not complaining about that. 5% of my tax bill goes to support the community college. 2% goes to the library. About 1.2% goes to the park district. And then another 2% goes for township roads because I live near a small community which the township takes care and maintains the roads. So it's taxes paid, but taxes that you pretty much see on a tax bill and what they're going for, along with all the other homeowners in that particular taxing district. So just talking a little bit about credit counseling, because people do have to be aware that it's very difficult just to walk in cold and get a loan. Many times there is credit counseling that is available and will help you with some of the issues. Some of these credit counseling services are online. Many of them are HUD approved. I looked in the state of Illinois as an example. We have 89 HUD approved credit counselors in the state of Illinois. We also have a very large city, Chicago, where many of them are based, but they are spread out around the state. You go to a state that's more rural, like Wyoming, there's only 2 credit counselors that are approved by HUD. So it's kind of across the board where they are, but you can go to HUD.gov and find out where they are. And they typically, these organizations have experienced people, and they'll go through a long list of things that you might be interested in. All of these may not pertain to you, but you can probably find something that you're interested in and get started and see what they have to offer. And basically to start educating yourself about the homeowner process. So I just wanted to take briefly, the next slide, just briefly go through some loan programs that are out there. And I'm going to be very brief here. These all have different eligibility requirements, but some of these tend to be overlooked, I think, particularly in the rural Native American sector, from the standpoint of just being available and accessing, many cases, local banks. They'll be involved in these programs. We'll start with the Veterans Administration. As I mentioned before, this is a program that has 0% down payment with no mortgage insurance. It is a benefit that can be used multiple times, which some veterans aren't aware of, and the benefit doesn't expire. And in some cases, the surviving spouse of a veteran can also make the program work for them. It is available through local lenders, so you'd want to ask your lender whether they participate in the VA guaranteed loan program. And you can buy, refinance, and do home equity loans with that program. And there are fee waivers for vets that have disabilities. The next program is a rural development program. It's a 502 direct loan program. It's been out there for a long time. Last year, it was funded at $1.1 billion. That was actually $100 million more last year than the year before. And interestingly enough, all that $100 million increase was used. 0% down payment. It has 33 and 38-year terms. They can go out longer on 38 years if you have a lower income. It is a fixed rate loan, but they can subsidize the loan down to 1% interest. The moratorium features with this program are important so that if you have a disruption in income, you have some major health issues, or the wage earner in the family has some issues, rural development can actually suspend your payments for a short period of time and allow you to get back on your feet and keep your home. The one important thing to remember about this program, as the next one, which is the 502 Guaranteed program, is you have to live in a rural area. So they have their maps, they have their areas that are designated as rural, non-rural, and so it's very important, one of the key things to look at first, but it's helped thousands of families and households across the country being able to afford a home. And there were just over 7,000 loans that were made in fiscal year 2018, and the average household income for these borrowers was just under $34,000. So for this particular loan, you apply at a rural development office, or they do have packagers now that are working across the country. A packager is an independent person or a agency or an organization that is doing the paperwork for rural development, and they will get paid once the loan is made with rural development, so that you don't necessarily have to drive all the way to a rural development office, which can be a lengthy drive because they've consolidated their offices now and don't have as many as they used to. So the Guaranteed 502 loan program is through a lender, your local community bank, or a lender that's participating with this program. Rural development will go out and they will qualify the lender so that when the lender does the paperwork with you and they're asking for a guarantee from USDA, that guarantee, yes or no, will come fairly quickly. In most states, the Rural Development Office is promising 1 to 3 day turnaround on the guarantee request. It does allow higher incomes for this program. You can go up to 115% area median income. You still have to be in a rural area, so that is a key qualifier. But they're making many more loans in the direct loan program, mainly because this is a guaranteed program. Again, it's the lender's money that's going out the door, and if you default on the loan, goes into foreclosure, the home is sold, the guarantee comes from Rural Development, USDA, to make the lender whole. So this program had made just over 115,000 loans, significant number of loans, in fiscal year 2018. They have budget authority up to $24 billion for this program. In fiscal year 2018, they made just over $16 billion of guarantees. They notice here that compared to the 502 Direct, this is hitting an income band that's much higher. You're at $61,000 being the average household income for this particular program. But a very relevant program for rural America. The next program I just want to talk about briefly is the HUD 184 Loan Guarantee. This is a loan program, a single-family housing loan program, condos, other types of real estate for Native Americans only. It's a very popular program. These loans can be made anywhere. Again, you're going through a private lender, so there's a guarantee from HUD to the lender against default. The one important thing to keep in mind is that the 184 program is not available in all states. Most states, but not all. And HUD has a good map showing where those are. It does have some down payment requirements, but it does also have a nice feature that it has an assumable mortgage. So if you were in a situation where you had to sell or leave your home, you could actually have a family member or someone else assume your mortgage, which is very important in today's climate because interest rates are very low. So if you get a mortgage and it doesn't work out for you, someone can assume that very low mortgage and not have to take out a new loan at perhaps down the road at a much higher interest rate. And many tribes around the country are taking advantage of this and building homes, because they understand that these low interest rates may not last forever, and this is a good time to get in on this program. Over 90% of these loans are made on fee simple land. There is a big effort around the country to do more of these home ownership loans on trust land. And Enterprise is very much involved in that effort with some of the work that we're doing on technical assistance and home ownership on trust land. And I don't want to miss the housing finance agencies or authorities around the country. Each state has one. Many of the housing finance agencies you may be aware of if you're in the rental market or a housing developer that does rental housing. Many of these issue tax credits, low-income housing tax credits, but most of them also have a single-family housing program. They're able to go out and borrow money at very favorable rates, and they'll put it out with their own state priorities and their own programming, typically driven by their board of directors. Many of these programs are for first-time home buyers. Many of the programs in recent years have been for what is called the essential workforce in communities where police, firefighters, and teachers don't have the highest of income, but you want them to work and live locally where these jobs are, and so they've put out special rates and programming. Many of them do have also down payment assistance that's available. Typically just some factors here that most of them will look at from the standpoint of work history, home buyer education, owner occupied. The next slide is just kind of a wrap-up slide, and I just want to emphasize that owning a home has many benefits. And again, home ownership may not be for everybody, but it's certainly worth a look at from the standpoint of the benefits and if it fits your situation. It always helps to know what you can afford initially and then long-term. Long-term being you're going to have an initial mortgage payment, you're going to have some additional insurance, taxes, and maintenance on the home. Those are all things you need to budget for and be aware that those are going to be your payments. You want to prepare yourself, as we mentioned before, check your credit, clean up your credit, look at some of your down payment options that are out there. There are programs that are willing to help. Do you need credit counseling? Now is a good time to start that process, and some of those are, again, available online. Always seek out a member if you have a family member or if you have a neighbor or somebody that you trust that has gone through the home ownership experience and gone out looking for a mortgage. Talk to them. Talk about some of their experiences. Word of mouth is very important, but again, it's going to be your individual situation, your individual numbers, employment, income, credit that is going to be able to allow you to take out a mortgage, buy a home. And with that, good luck. We wish you well in your efforts of looking for a home. And the best way, perhaps, to celebrate Home Ownership Month is to buy a house.
Thanks, Russ. That was a very, very informative and great presentation. So far, I do not see any questions in the chat box or the Q&A panel, so I'm going to go ahead and unmute participants. And if you have questions for Russ, please go ahead and ask them now. Everyone should be unmuted.
No questions. This is Cindy Butterfield from the Red Cliff Chippewa Housing Authority. I just wanted to say thank you, that this was very informative for me, and I look forward to any future webinars that you have to offer.
Great, thank you.
Anybody else on the line have a question or comment?
Well, I want to thank everybody for joining us today. We're always interested in other topics that you might want to hear about. There's lots of things that we can bring forward with this platform on webinars, so don't be afraid to send in your suggestions to Sarah or Adrian or myself. We'd be very happy to take those into consideration and line up some speakers that can address the issues that are important to you.
Yes, thank you everyone for your time today, and we will share the recording soon. So everyone, have a great day.
You too, thank you.